All right, today we are diving deep into one of the biggest buzzwords in finance, real-world asset tokenization. We're going to unpack what it is, how it works, and what it really means for the future of money. Let's get into it.
So imagine this. Could you actually own a tiny piece of a skyscraper or a sliver of a famous painting? That's the big, flashy promise of RWA tokenization. But how much of that is just hype and how much is a real game changer for finance? Well, that's exactly what we're here to figure out. So first things first, let's really get a handle on the big vision here. What's the promise that has everyone so excited, and what are the economic forces driving this whole thing forward?
Okay, so what are we really talking about here? At its heart, RWA tokenization is about creating a kind of digital twin for a real-world thing. You take an asset and you create a token on a blockchain that represents your ownership of it. But, and this is the most important part, it's all connected through legal structures. This isn't just some tech fantasy. It's about building a solid bridge between the new digital world and a legal system we already have.
But why? Why are huge financial institutions pouring literally billions of dollars into this space? Well, it really boils down to a few key things. The number one reason you hear is liquidity, the dream of taking something huge and illiquid, like a commercial building, and chopping it up into a million tiny tradable pieces. And right behind that is market access, the idea of opening up investments that, until now, were pretty much only for the super rich.
And the scale we're talking about here is just staggering. Seriously, we're talking about trillions of dollars currently locked up in assets you can't easily buy or sell, things like real estate, private equity, you name it. The vision is to drag all of that value into a modern digital marketplace. It's a really powerful idea, but as you're about to see, the reality is a whole lot messier.
Okay, so that's the what and the why. But how does this stuff actually work? Let's pull back the curtain and look at the nuts and bolts of how you turn a building into a token. So it usually happens in 4 steps. First, you've got the actual asset. Let's stick with our skyscraper. Step 2, that building gets put inside a legal wrapper, which is usually a company called a special purpose vehicle, or SPV. So now this new company legally owns the building. It's only then, in step 3, that the tokens are created. And these tokens, they represent a share in that company, the SPV. And finally, all of this is tracked on a blockchain, which just acts as the official record of who owns which tokens.
Now, I really want you to let this next point sink in, because it's absolutely crucial. When you buy one of these tokens, you do not own the physical bricks and steel of the skyscraper. No way. What you own is a share in the company that owns the skyscraper. It sounds like a small difference, but legally, it's a massive one. It changes everything about how your rights are protected.
And that brings us to this quote, which just hits the nail on the head. For any of this to be taken seriously, it has to start with law, not with code. The tech is cool, for sure, but the real foundation, the thing that gives a token any actual value, is the boring old legal contract behind it. And that leads us right into a much-needed reality check. All right, it's time to cut through the hype. Let's talk about some of the big myths floating around RWA tokenization and get real about the challenges that people are facing on the ground.
Let's start with the biggest myth of them all, the idea that tokenizing something magically makes it liquid. It just doesn't. All you're really doing is fragmenting the ownership. You're breaking one big thing into lots of little pieces, but you still need people who want to buy and sell those pieces. Without a real market with real demand, all you've done is turn one big illiquid asset into 1,000 tiny illiquid assets.
And then there's that phrase you hear all the time in crypto: code is law. Look, in the real world of assets and legal contracts, that's just not how it works. A smart contract is fantastic for automating things, like, say, automatically paying out dividends. But if something goes wrong, if there's a dispute, the final say doesn't come from the blockchain. It comes from a judge in a courtroom looking at a legal agreement.
We also hear a ton about making settlement more efficient. And yeah, blockchain can settle trades faster, but let's be honest, for an asset like real estate, is the 2 days it takes to settle a transaction really the biggest problem? Of course not. The real challenges, the real friction, comes from things like getting the property value, doing due diligence. That's where the time and money go, not in the final settlement.
And the list of headaches goes on, believe me. Big institutions have to figure out how to even account for these things on their balance sheets. How do you audit ownership when it's just a private key? And you've got this wild patchwork of different regulations in every country. The point is, this is not a simple off-the-shelf solution, not by a long shot.
Okay, so after all that, you might be thinking this whole thing is just a mess.
But it's not. Despite the challenges, RW tokenization is already delivering real value in some very specific areas. So let's look at where this is actually gaining traction today.
This is where the technology starts to look really smart. In the world of private credit, for example, it can automate incredibly complex payment schedules. For something like government bonds, it can offer the super-fast settlement that traders need. And for carbon credits, the transparency of the blockchain can finally help solve that huge problem of people selling the same credit twice.
So what's the pattern here? What do all these successful examples have in common? The real value, it seems, isn't just in tokenizing some static object. It's in tokenizing assets that have complex, moving parts, like frequent cash flows, where the automation and transparency of a smart contract can actually make a huge difference in cutting costs and reducing risk.
So, what does this all add up to for the future of finance? For our last section, let's zoom all the way out and think about the true strategic impact of all this.
I love this quote because I think it is the single most important idea to grasp. RWA tokenization isn't inventing some brand new form of economic value. It's not magic. What it's really doing is re-engineering the plumbing of the financial system, all the boring, back-office stuff that makes capital markets work. It's about upgrading the infrastructure. And that means all those big institutions we have today, the custodians, the transfer agents, they're not just going to pack up and go home. Their jobs are just going to change. Instead of holding paper stock certificates in a vault, a custodian will be responsible for safeguarding digital private keys. They're going to adapt and evolve, not go extinct. So in the end, the success of this entire ecosystem isn't going to be decided by who writes the cleverest code. It's going to be built on three much more traditional pillars: solid legal design, disciplined governance, and good old-fashioned institutional trust that the system works and is safe.
Which really leaves us with one final big question. The technology, when you boil it all down, is just a tool. It's a powerful enabler, for sure, but it is not a substitute for the legal and governance systems that our entire economy is built on. So the real question isn't whether the technology is ready for finance. It's whether our financial and legal institutions are ready for the technology.